Pretty interesting GameStop.
The whole GameStop situation.
GameStop's stock is surging.
Robinhood started limiting orders on a couple of stocks.
Institutional investors were making money by shorting GameStop.
Hey guys, my name is Mayur and I want to welcome everybody to the Day Trading Club, where we trade stocks, options, and crypto. Just a quick note to mention, I am not a financial advisor. All the information that I'm going to give you in today's class is just my opinion. Always do your own due diligence and good luck out there. Thank you. There's a bunch of different order types when buying and trading stocks and options. The first type of order is a market order. That means I'm willing to pay whatever the market price is. So for example, if Apple's $100 and you put a market order in, whatever the highest, the lowest bid is, you're going to buy it for. So it could change somewhat dramatically from the time you put the market order in. The reason people put market orders in is they want to get in right away. The pros are you're in immediately and you're in the action. The cons of a market order is you might purchase or sell a stock at a price that you're unhappy with. The other type of orders are limit orders. That's when you are basically putting in exactly how much you want to buy something for. So let's take an example of Apple. If Apple is trading at $100 a share, you could put a limit order in for $99.50. That means it is not going to buy those shares until it hits that exact penny amount. The good thing is, you know, you're not paying a penny above $9.50. The bad thing is it could be trading at 100, drop down to, you know, 99.70 and not hit your order. That's where a market order would come into place. So what I like to do is when I want to get into a stock, I'll usually look and find the supply and demand zones. That's basically the supply is where basically the bottom of the zone where basically it hits where the hedge funds are buying, and the demand is where they're selling. So you want to pay attention to those two zones, and I'm actually going to show you how to find those zones. So if you know that Apple stock constantly goes up at $99.86 and it never goes below that and always bounces right off of that, it's more advantageous for you to put a limit order in a few pennies above. So when it hits that bottom price, you get to pick it up at the cheapest amount. Putting in limit orders for buying stocks is great. Putting market orders when you want to get out is something that most traders do because it helps you to immediately get out. Let's say that you're in a stock like Apple and it's $100 and today they have bad news and they're dropping. Well, if you put a limit order in, it may not hit because it's dropping so fast. What you want to do is a market order so that you can get out of there immediately. You may lose a little bit, but you're guaranteed to get out. Another way to prevent from losing too much on a stock is by putting a stop loss. Immediately after you buy a stock, let's say Apple, you could say, I'm putting in a stop loss at $5. That means if it goes to $95, it will immediately sell. That way it protects you from losing more than 5%. Another way that you can sell a stock without having to put an exact dollar amount is by putting what we call a trailing stop loss. You can put in a percentage. That means, you know, what I do is a lot of times I'll find a stock that's hot, that's moving up a lot, and you can't watch it all day long. And so you can buy it at a limit price. Once you're in the stock, you can set a trailing stop loss, which means if it drops X percentage, let's say 3 or 5% from its highest price, it'll sell. The good thing about a trailing stop loss is if you buy it at 100, you walk away and the stock ends up going up to 150 or 160 and then drops a few percent, it'll sell up there because of the trailing stop loss. It looks like we have a question.
Joe Turco asked, should a stop loss be put on every stock? Is that a best practice for short-term holds?
Absolutely. If you don't have a trading plan, which is basically, here's the stock I'm going to buy, here's my entry price, here's my target sale price, and here's my stop loss price, you shouldn't make the trade. So let's take an example. If your goal is to buy Apple at $100 and sell it at 105, well, you've got a good trading plan. You can do a limit order at 100, and then you could have a separate limit sell at 105, but you'd want to protect yourself and put a trailing stop loss of maybe 2 or 3% or a dollar amount. When you're trading, you should have a journal and you should know these things. Here's a stock I want to buy. Here's the price I want to get in at. Here's my target price to sell at, and here's my stop loss. Trust me, more times than not, if you don't have a stop loss and you go for the moon, you usually end up in the basement. So these are the type of market orders. Market, hey, I'm in right away. Limit, it has to hit this exact amount before I buy it, before I sell it. A stop loss could be at a dollar amount, or it could be at a percentage amount, depending on what your risk level is. In my opinion, you shouldn't lose more than 5 or 10% in a trade. Now, be careful. You don't want to pick up a stock that moves 5 or 10% a day and buy it at 100. It drops down 5%. You have a trailing stop loss itself, and then it goes right back up. That's why you need to be very firm on what the supply and demand zones are. In almost every stock, you'll see that it hits a bottom at a certain price and it hits a top at a certain price. If you know these two prices, then you can create your trading plan for the amount you want in at, your exit price, and your stop loss price. Let's talk about shorting stock. So when you're buying a stock, you're what we're calling going long. You're hoping that you buy Apple at 100 and that it goes up. But there are also the people that are hoping a stock will go down. That's what you call shorting a stock. So there's a lot of people that will short Apple, let's say at $100. The market and limit orders and trailing stop loss work the exact same way, but it's in reverse. So in a typical situation, you would buy Apple and hope it goes up. In a shorting situation, you would short it and hope it goes down. And if you want a stop loss on a short, it's called a buy to cover. So that means if you short Apple at 100 and it goes up 5%, as a short seller, you're losing money. So instead of putting a stop loss below, you're putting one above, making sure it doesn't go too high. And that's called a buy to cover. And you'll read a lot about shorts covering a stock. And that is why GameStop and AMC and Bed Bath & Beyond, a lot of these stocks that were heavily shorted skyrocketed up, because when they were going up, people were shorting them. They had a stop loss that if it went too high, that they would get out. And all those people got out at the same time, which drove the prices up. When you're shorting stock, you have to have a margin account. So what does that mean? That means your broker has to let you borrow money, because the stock could indefinitely keep going up. So that's an amount, it's kind of like credit that they give you. And if you go above it, they'll call you in what's called a margin call, and you're going to have to pay for everything. So be very careful when shorting a stock to also have a buy to cover or a target price. If the stock goes up too high, that you're going to get out. In order to open up a margin account, you're going to need to have usually a minimum of $25,000 in your account. That's also the minimum to day trade. And so if you're buying Apple for $100 and selling it the same day, you're going to get what you call a day trading violation, which means you can only do about 3 or 4 of those until you can't make any more trades, unless your account balance the following day is above $25,000, or you buy the stock on a Monday and sell it on a Tuesday. You can sell it the very next day, but you cannot buy and sell the same stock on the same day without a $25,000 balance. You also can't short without a margin account. And most margin accounts will also ask that you have a $25,000 balance. Rule of thumb, unless you are really sophisticated in the market, don't use a margin account. It's credit that you don't have, and unless you are 100 million% certain, I wouldn't touch margin at all. Trading platforms. So a lot of people ask me, hey, what's the best trading platform? You know, it depends on what you're doing. Are you buying stocks? Are you shorting stocks? Are you trading options? Are you trading crypto? Are you doing all three? Do you want something that's easy to use? Do you want something that links really well with your bank? I'd say the top trading platforms that I use are Robinhood. I know it has a lot of negative news lately going on. The reason I use it is it's really easy. It's really easy to buy and sell. They give everybody a margin account. If you enable that, you can enable options trading, and you can trade crypto. And so you get to basically do all three in a super easy platform. If you don't already have one, ask somebody that has a Robinhood to refer you, and you both get a free stock. I actually heard of somebody who referred somebody to Robinhood, and the free stock they got was GameStop, and that went up to 400 and changed a couple days ago. Webull is another platform. Robinhood and Webull both don't charge you for trades. They make their money on a lot of different ways, and a lot of different ways is when you buy or sell a stock, they're taking a small percentage. So don't do too heavy amounts in there. They're good beginner accounts. to learn a simple interface. Merrill Edge is my primary trading account. It's a big brokerage. They're connected to Bank of America. The great thing is if I make a trade on Merrill Edge and I close it, I can transfer that money to my checking account and use it within minutes. TradeStation is a favorite by candlestick traders. So that's where you chart the candlesticks and different analytics in a stock. It's a phenomenal platform, both mobile and web-based. Definitely takes a lot more learning curve to use it. But if anybody's interested in trading kind of full-time or doing this more extensively, that's a great one. There's also market data on TradeStation that you can't get anywhere. So I can see the entire stock market of what the top gainers are that day, what the top losers are by percentage, by dollar amount, and more importantly, I can see stocks that are rapidly rising and rapidly falling. Well, why would that help me? Well, every day I have those two links up. And if I look at stocks that are rapidly rising, guess what I'm going to do? I'm going to buy into those or go long. If I see stocks that are rapidly falling, guess what I'm going to do? I'm going to short those. We have a question?
Is ETrade bad then?
You know what? I've never used ETrade. I've never heard anybody give me any pros or cons on it, so I can't give any advice.
I think they just went free or sort of a Robinhood model with some of that pricing pressure. And ETrade's like an in-between. It's like in between Robinhood and TradeStation or Merrill.
It's free and it's a little bit confusing, quite frankly. Robinhood, like literally, you could have a 3-year-old use it. There's 100 other brokers. There's e-brokers. TD Ameritrade is the favorite one, again, for options traders. Pick the one that you like best, put a very small amount in, and see how it goes. So let's talk about resources and how I find my stocks and options. The number one resource that I use is bar chart. And so John is going to go to bar chart right now and show you a little bit about it. So the first thing I look up here is in the tab under stocks. And then you can go to top stocks to own. And then, so now you have a list of what bar chart recommends the top stocks to buy. You could sort them by dollar amount. So if you're a new trader, resort it by price, find the cheapest stocks on there that have a 100% recommended buy rating and buy them. You could do the exact opposite on the tab above where it says bottom. And these are the worst stocks to own. And you could basically sort this however you like and short those. Again, shorting is not for beginners. So I would recommend going to the top 100 stocks to buy, sorting it by dollar amount, finding the cheapest ones, typically the ones below $5 or $10, and wait for any of those to have a red day. I typically will never buy a stock if it's already green. It has to be red or has to be a dip, has to be at that bottom zone before I buy it. And the opposite goes if I'm going to short stock. If I'm going to short a stock, I want to see it skyrocketing, having its best day out of the year so I can ride it all the way down. Another resource on bar chart is options. So we're going to click on the options tab, and then we're going to click on unusual options. So every single morning at 7:05 a.m., this is updated, and it's updated throughout the day. What you're going to want to do is sort it by options volume at the top. And typically, the top 5 highest volume options are going to be the biggest movers that day in the market or that week or that month. I have a very simple strategy. Every single Monday morning at 7 o'clock or 7:05, I'll resort this list by the highest volume. So if you look at the top 5, the top 1 or 2 or 3 or 4 is almost always going to be Apple. So I usually disregard that. It's kind of a given. It's there no matter what. But everything below Apple that's on there that has high volume, I will typically purchase. Some of those will be calls, some of those will be puts, and those are options, which I'll explain in a moment. Another way to re-examine which options are hot is under the options tab, you click on most active options. And so we're going to be going there right now. In here, you can look at the most active options, and more importantly, you can look at the call to put ratio. And you can see that some of these have a lot of calls. A lot of calls means everybody's betting that the stock is going to go up. If there's a lot of puts, everybody's betting it's going to go down. So you can look at the unusual options. You can find the options with the highest volume, and then you can cross-reference that with how many calls to puts are on that. Another way to analyze unusual options, and unusual options, by the way, is basically things that are unusual that are happening. Is there an earnings report coming out? Is there some news coming out that we don't know about? Typically, the hedge funds and big traders, they pay millions of dollars for information before you and I, and they have to publicly, that has to be public information on how much they're betting on stocks. So if you knew that a hedge fund was betting, let's say $100 million that Apple was going to go up $5 tomorrow, would you buy Apple stock today? Another thing that you could do on unusual options is click by last trade. John's going to show you how to do that. So in the very right column, it shows you the time that the trade was entered. You click it a couple times until it shows you the last time available, which is usually a few seconds ago.
So six of the last 10 are all Snap.
Calls or puts?
Calls.
And what is Snap doing right now?
Earnings.
And what's their percentage gain or loss right now?
I don't know.
So as we pull that up, we will continue on. But that's a great way at the very end of the day. Most real traders are
down 6.5.
Down 6.5. Okay, well, we'll see. Most traders are making their trades at the very end of the day. And why is that? Because they've already got to see how the day played out, and they are basically betting on what's going to happen the following day. Another system to find unusual options is Sweepcast. Sweepcast also shows you unusual options flow, just like bar chart. It is a paid service. You have to pay like $20 a month, but it gives you the data a little bit faster than bar chart. And the quicker you get the information, the quicker you can act before the big boys do. Another good resource is Stock Tweets. Stock Tweets is like Twitter, but for stocks. It's basically people like you and I posting information about different stocks. Keep in mind, this is 100% user-based, so you can't take anything on there as verified information, but it's a good way to gauge which way the stock is going. Typically, before I buy a stock, I find it on bar chart and Sweepcast. It shows me that there's a lot of options or a lot of calls or a lot of puts on it. And then I can go into Stock Tweets and just read what people are saying. If everybody on Stock Tweets is saying, hey, this is a bad stock, it's garbage, it's going to tank, and you see 99 out of 100 comments saying that, you probably don't want to go long on that. And the reverse happens if you're trading the other way. So that is a very small component to the equation if you should make a trade or not. But it's also a great place just to find different information. A lot of times, users will take data all over the internet and place it on their stock. So if there's a new news article on Snapchat.
I'm just going to go to Tesla. So if we're on Tesla and I scroll down, right, we can see, so they've tagged Ford, and then they said re-rate to be like Tesla. So you'll see a crossover between different stocks linked in one page.
Yeah, and it's a great place to find stocks. The other thing about Stock Tweets is at the very top of Stock Tweets, if you're on the mobile app, it'll show trending. And these are the top 20 most trending or top 10 most trending stocks. Typically, these are the top 10 or 20 that are skyrocketing to the moon or falling to the floor. And that's a great place to kind of find trades and see where they're going and pick up some information.
And they have an earnings calendar.
And they have an earnings calendar. Every company needs to report earnings once a quarter if they're a publicly traded company, and they give you the dates that they're all reporting. Some of the reportings are before the market opens, so usually at around 6 a.m. Pacific Standard Time, or they're after the market closes, which is usually a few minutes after 1 p.m. Pacific Standard Time. Speaking of time, the stock market works on the Eastern Standard Time because it's in New York. And so the stock market in New York opens up at 9:30 a.m. every day, which means in California, it opens up at 6:30. It closes there at 4 p.m. each day, which means that the bell closes in California at 1 o'clock, something to keep in mind. The final resource I want to talk about is one of my coaches and mentors. It's called Dekmar Trades, the young day trader who live streams trading all day long. So you could literally pay him, it's 50 or 60 bucks a month. And at 6 in the morning, he goes over all of the hot penny stocks. Penny stocks are very lucrative. You can make or lose a lot of money. The great thing about what Sean does is he's live trading every single stock, and he tells you when he goes in, when he goes out, and he shows you his profit. And so when you add up all these resources together, you can make a more educated decision. Let's talk a little bit about options. Options are like trading stocks, but what you're doing is you're purchasing 100 shares of stock or shorting 100 shares of stock at a given price and a given date. I'm not going to go too much further into options because that could literally take hours. I can tell you that you need to master stocks first, and then you need to get into options after. Options are also a great way to make extra income because you can not only buy calls, which means I hope Apple goes up, or buy puts, which means I hope Apple goes down. You can also sell calls and puts. So if you own, let's say, 100 shares of Apple and it's trading at 100 bucks, you could sell puts against it and make a premium, assuming it doesn't go down below your put price. You could also sell out of the money calls, like, hey, next week it's, I'm going to sell calls at 140 bucks. It's probably not going to jump 40 bucks, but there are people out there willing to pay you for the opportunity to do that. And that's a great way to create income for yourself if you have shares of stock. If you own over 100 shares of stock in anything, you should be either buying or selling a call or a put on it one way or another. It's just free money, and you can go as far out as you want to make sure that there's almost no risk to you. Cryptocurrency. So cryptocurrency is the new craze now. Everyone's talking about Bitcoin. I think it's at like 37, 38,000. Last week, it hit its bottom resistance. The bottom resistance was basically 29,000. And since then, it's bounced right back up to about 37. So that's a clear zone. When Bitcoin hits the 29s, buy it. When it hits the 35, 36, 37s, probably not a good time to buy it. Probably a good time to wait. There's hundreds, if not thousands, of types of crypto. The main ones are Bitcoin, Ethereum, and Dogecoin. I still don't know how to pronounce that. Dogcoin, the doggy. Today is a big day for Dogecoin. They were supposed to go up because of Wall Street bets and all this hype. I think they went up like 40 or 50%. In crypto, guys, it's the exact same thing. There is a zone for each crypto. There is a bottom price that they go up at, and there is a top price they go down at. Just start to research where you can find those. Speaking of which, I want to show you a shortcut on how to find these zones in bar chart. So John's going to pull up bar chart, and he's going to go to Tesla. So how do you know where Tesla bounces from at the bottom or the top? Well, you can spend hours and hours of research, or you can scroll down. At the very bottom right-hand corner, right here, it shows you the last price is at 849, and it shows you the first, second, and third support levels. So that's it'll typically bounce at first support level, if not second or third. So if you're going to put a limit order in for Tesla, you should put it in at what, John? Bottom support.
820.
And if you are holding Tesla and you are a little scared that it could go down, at what point is the highest that it typically goes down at?
900.
So tell me that zone again.
820 to 900.
Anybody else been watching Tesla? Anybody else see these two zones or where it hits? So when it hits 820, you know what? Put a limit order for 822. And then as soon as you buy it, put a limit sell for 895, and you can sit back and relax. Or when it hits 820, you buy a call option on it. Or when it hits 900, you can buy a put option on it. Back in crypto. So you have Bitcoin, Dogecoin, all these different things. They work on the same zones. They're not optionable. They trade 24 hours a day. So if you're like me and you get incredibly bored on the weekends because the market's closed, you can trade crypto. There are stocks related to crypto. The two stocks that we track for crypto are Mara and Bitcoin. So these are cryptocurrency miners. So they're mining Bitcoin. So when the price of Bitcoin goes up, they go up because they're mining it. When the price of Bitcoin goes down, they go down. So if you want to play Bitcoin or any of the cryptos, and you don't want to put your money in those, you want to put it into a stock, Mara and Riot are really good options for that. Unfortunately, they've already gone up about 1,000% this year since Bitcoin has also gone up significantly. Let's switch our attention to ETFs. These are called exchange traded funds. So this is basically a group of stocks that trade together. The main ETF is the SPY, and that is basically pretty much the entire stock market. So when the stock market goes up, SPY goes up. When the stock market goes down, SPY goes down. You could buy calls or puts on SPY, or if you think it's going to go up, you can buy ETrade, which is basically an ETF that's around the S&P. If you think if the SPY is going to go down, you could buy a put on anything like ETrade, or you buy UVXY. UVXY is a 3 times ETF on the VIX. The VIX is basically the fear factor. So when the market goes down, VIX goes up. And if you buy UVXY, it moves 3 times. So if the market goes up 1%, then the VIX will go down 3. If the market goes down 1%, UVXY will go up 3. And the thing that you need to know about the VIX is it trades pretty much in a zone of about $10.50 to about $14. When the VIX starts to go below 10.50 or even below 10, that's when the market is going to start having a correction. It means things are way too high and that you shouldn't have a lot of calls or you shouldn't own a lot of stocks without stop losses. When the VIX is really high, like, in the teens or, 13, 14, 15, 16, 17, 18, it works the opposite way. Everybody remember last March when the market was tanking? The VIXY was up like...
I'm showing it right now. It went to 135.
It went to $135 and came all the way back down to today's trade of like $10. This is awesome for insurance. So some people have big portfolios, Apple, Amazon, Lulu, Spotify, whatever it is that you have. If you're hoping everything goes up and you want some insurance and you don't want to put stop losses on everything because you have to pay taxes and you have to rebuy it. If you just have a huge portfolio, or if you're, fearing that the market's going to go down, you want to buy a little bit of the VIX. So if the market goes down, your stocks are all going to go down, but the VIX is going to go up and you're going to even out that day. And then when the market goes back up, you have your stocks going back up. You can get rid of the VIX, which was kind of your insurance policy. Other good ETFs are FNGU. FNGU is basically like the Avengers. It's an ETF that has Tesla, Apple, Amazon, Microsoft, all the big blue chips, all the big tech. Amazon, Tesla, we know how those move. FNGU, I think, is up like 300% this year from its low. If you think the market is going to go down, specifically Tesla or any of these big cap, then you can buy FNGD, which is the opposite. It hopes that these stocks go down. FNGD is shorting them. The Q, so a lot of times you'll hear on CNBC, the Q is up, the Q is down. The Q is the NASDAQ. It's basically all of the internet companies. It's all of the technology companies. So again, Apple, Amazon, Spotify. If it's an internet company, it's probably in the Q. Guess what? Internet's not going away. The Q just literally always goes up. If you want to play the Q and you want to get 3 times the volatility, you buy TQQQ. If you think the Q is going to go down, then you buy SQQQ. So SQQQ is shorting it. TQQQ means it's going up. You can also play the Dow. Everybody hears about the Dow Jones, right? The Dow Jones Industrial Average is up 86 points today or down. That's kind of the measure of the whole market. The Dow usually has 30 or 40 stocks in it. They're the average stocks in America, like Boeing and other big companies like that. Caterpillar. If you want to buy the Dow, you can buy UDow, which is a 3 times ETF. It's a 3 times multiple. For when the Dow goes up, UDow goes up 3%. Or you can short it and buy SDow, hoping the Dow will go down. little tip or trick here, UDOW and TQQQ and FNGU, these things just go up.
This is meant as fun. This is not advice, financial advice. But yeah, I just showed the charts.
They go up based on the charts. You might hear a lot about bull and bear. That's just a term. Bullish means that people think it's going up. Bearish means people think it's going down. If you go to Wall Street, you'll see the big bull outside because everybody in Wall Street hopes what? That everything goes up. Some quick tips. If you haven't traded before, or if you're just kind of new into trading, paper trade. That means write a journal out of saying, hey, I'm going to buy Apple stock today at 100. I'm going to sell at 105. I'm going to set my stop loss at 102 and play it out on paper without your own money. You're going to learn a lot that way, and there's no risk and everything to gain. Don't worry about missing out on gains on Apple that week. Stock market's open every single week, Monday through Friday, and it's always going to be there for you to trade. There's always a new trade or a new stock. So I recommend for everyone to paper trade for at least a month, maybe 3 months until you feel comfortable. Keep a trading journal. Put all your trades in there. If you're going to buy Apple, put here's how much I'm going to buy it at. Here's how much I'm going to sell it at. Here's my stop loss. And put 5 reasons why you're buying it. The number 1 reason should be it's a buy or a sell on bar chart. Number 2 reason you should buy or sell it is you've seen a high level of unusual options on it. Level 3, the 3rd reason could be because of pending news or that they're releasing earnings and they have some great new products. If you don't have 3 to 5 compelling reasons why you're buying or shorting a stock and the entry and exit price, then don't buy it. Dollar cost averaging. So this works in stocks. It doesn't work in options. But typically, let's say you bought Tesla. So Tesla, we said that it trades from around 820 to 900, right, John?
Yep.
So let's say you put in your limit order at 820, and it goes down. It goes down to 799, or even 795, or even 790. And the initial trade, you bought 100 shares. Well, it's below its 3rd resistance. It's most likely going to bounce back up, even though it fell below. So what you want to do is you want to pick up more shares so that your average cost isn't 820. Let's say you bought 100 shares at 820, and then you bought 100 shares at 790. Now your average cost is 805. I don't know, I'm not going to do quick math, but it's a little bit lower than your initial purchase price of 820. And then when you eventually sell it at 900, you ended up paying a better price for it, so you'll make more money. When you buy a stock, you should always buy it in thirds. So if you're planning on putting $1,000 into Apple on Monday, don't. Put $333 in Apple on Monday, wait a week or a month, and then buy another 333, and then take the same time duration and buy the final amount. Why? What happens if you buy Apple at $100 a share and it drops all the way down to 90 and then 80 and then 70? Well, you purchased 1/3 here, 1/3 at 90 and 1/3 at 80, and your average price becomes 90. So you can feel better about your trade that you're able to purchase at a lower price, lowering your average cost. Now, what happens if it goes up? Well, instead of buying it at 100, you buy some at 100, and then it goes up to 110 and 120, and you buy 100 shares at 100, 100 shares at 110, and 100 shares at 120. Now your average cost is 110. So it's higher than if you bought it all at once, but you protected yourself in case it went down. And guess what? It already went up. So you average cost is 110. It's now worth 120. You made money.
Run a scenario. Say I scaled in at 100, 110, 120, and now Apple's up to 200, and I want to start to get out.
Well, what you want to do is have a trading plan. So what dollar amount do you want to get out of Apple at? What's the best way to look for that? You go on bar chart, you put an Apple, you scroll down to the bottom, and you look at the zones. And the top zone on Apple will tell you that the top resistance point That's a point you want to get out, because that's a point that the hedge funds have put in their limit sell orders to get out. So you want to get out with them. My OTA. So I learned how to trade stocks and options at a class called My Online Trading Academy. It's a phenomenal class. It's the only class. It's like a college level class to teach you how to trade. They're online. They have a corporate office in Irvine. Check them out. They're online. They have commercials at 3 in the morning if you're up watching CNBC like I am. Really great class. Very expensive, big time commitment. It'll pay off in the end. SPACs. SPACs are a new way for companies to go public. Traditionally, a company would have to file an IPO, which costs them tens of millions of dollars. Then the company would be released onto the market on a given date at a given price under their ticker name. So let's just say Amazon. In a new trading world that we're in, a SPAC is what you call an acquisition company or a blank check company. So I'll give you an example of one. CCIV. So that is the ticker name. It's not a company. It actually doesn't hold anything, has no employees. They are simply going to attract another company that is about to go public and merge them together. And their ticker will change from CCIV to the new name of the company. The difference here in a SPAC is the company doesn't have to spend tens of millions of dollars to IPO, which means the typical consumer like you or me can buy CCIV, or most typical SPACs come out at around $10. So you get kind of the insider price before it goes bananas and picks a company. There's a famous hedge fund billionaire, trader, all-around philanthropist, Chamath P. Guy's a genius. He has launched a series of SPACs called IPO A, IPO B, IPO C, IPO D. So he launches a SPAC, launches it at $10. Usually it goes from 10 to about 13 or 14. Once he finds a company to merge with, it usually goes bananas from there. His first SPAC was IPO A, which eventually turned into Space, which is SPCE, which is partnered up with Richard Branson. I think I last looked at it, $59. After that, he launched IPO B. IPO B, John, was Open Door. Open Door is trading around $30. You were able to buy Open Door before it became Open Door as IPO B at $10. Then he had IPO C, which became Clover Health.
Drama today.
Not a good day for Clove. He's also announced IPO D, E, and F. And a great place to learn more about these is just to look them up on stock tweets to get the rumors of which companies they're merging with. SPACs are hot. If you can get a good one that's under $10, I think it's a good idea to hold those for long term. But you do have to hold those for the long term, because sometimes they take 6 months or a year to merge with another company. Never short a monster. I've learned this lesson painfully. If you see all the signs in the world say to short Amazon, don't do it. Beyond Meat. There's a lot of really big companies out there that no matter what their news is, CEO could quit, there could be a scandal, they could have production problems. They just keep going up because hedge funds and people in their IRAs and 401ks keep buying them. If you're going to short a stock, short like a loser stock, something that is already kind of on weak footing, not a big company. So that's the advice I give on that. When to buy? I'll buy on Mondays. So Monday mornings are for buying. Typically, the market sells off on a Friday. So I'll start selling most of my positions on Thursday night and Friday morning. Pay attention to the season that you're in. The seasons affect the stock market. So January, that's called the January effect. Every January, the stock market usually goes up. It's the start of the year. Everybody wants to make money. At the end of the year, there's a Santa rally. At the end of the year, everybody wants Christmas money and they're at home and they're trading. 2 times out of the year that people sell a lot are February and May. They're just typically bad months if you want to go up. So those are the months to get out. There's actually a saying, sell in May and go away. Summer is a great time for the stock market, especially travel related stocks. What do you do in summer? Well, without COVID, you hop on a plane, JetBlue, you go to the Marriott, and you go to an entertainment venue and you buy your tickets on Ticketmaster. Well, typically those type of stocks that are travel related in summer months will go up, and typically you'll see them go down in bad weather months.
Candles.
So candles are basically how a stock moves at a given time. Usually they're in 1 minute increments, depending on how you look at them. If either they're red, which means the stock during that minute time frame is going down, or they're green, which means in that 1 minute stock time frame they're going up. People don't know, like on Robinhood, if you're looking at Apple stock, there's a little button in the right hand corner, kind of looks like, I think 3 bars. It'll change the line of the stock into candlesticks. If you want to know more about candlesticks, my OTA is a great place to learn it. And the best platform if you're using candlesticks is through TradeStation. Honestly, candlestick trading is very, very, very advanced. Just know that when you see a lot of green candles, you're probably making money if you're long. And if you see a lot of red candles, you're probably losing money. Well, I hope this class was informative. Again, I'm not giving out financial advice. These are just some tips and tricks that I use. If you're interested in learning more or speaking with me directly, you can actually give me a call or send me a message on my cell phone at any time. I love talking about the market. My number is 714-269-8146. There'll also be a link for my email, my website, and all that good stuff in our YouTube page. So good luck out there trading, everybody. And actually, sorry. I do have one more tip. I want to talk to you guys about my favorite stock. My favorite stock this year and last year, the stock symbol is EXPI. That is for eXp Realty. Why? Well, it's not because I'm an EXP agent, or I think that this is one of the greatest companies and not only the best real estate company out there, but so does the market. And what is a clear illustration of that? Well, EXPI is a stock ticker. I actually joined EXP in January of last year. And one of the great things about being at EXP is they give you free shares of stock and they let you purchase at a discount. But if you're not an EXP and you're just looking at the stock market, you could have bought EXP last January at $6, where me and my partner John were preaching it actually on Facebook. We were telling people it's your last chance to get in before $10. Well, over the last 12 months, EXP has gone from $6 to $125.72 as of 1 p.m. today. That is a 1,050% gain in a year. It's more than Tesla. So that is my favorite stock of the year. Now, if you want to know how to trade it and you paid attention, I'm going to give you 2 strategies and then we're going to finish up. The first strategy is to just buy shares and hold it. You silly people, it's up 1,050%. It's one of the greatest stocks in the entire stock market over the last year. If you're buying shares on it and you know how to trade options, then you should buy shares and sell puts or out of the money calls on it. And that's a little bit more advanced if you're an options trader. Or you can buy in the money calls 1 month out. And so what you would do, if EXP is trading at $127 right now in early February, what you would do is you would buy the $127 call. That's in the money, so it's right there, for 1 month out. So let's say March, whatever the next trading date is for March 5th. So you would go on, let's say Robinhood, you would do trade options, EXPI, you would go to March 5th, you would buy a call, and you would buy the 127 at whatever the price is. You could still put a limit order or market order for the option. Now here's the secret. Since pretty much in the last year, the stock has gone up almost every single week and month. What you could do is you could buy those in the money 1 month out calls, somewhat in between the time that you bought them and the date of expiration. They'll probably go up 100% or more. When they go up 100%, sell your principal. So if you put in $1,000 and they've gone up 100%, now your options worth $2,000. Sell your principal back in your pocket and let the rest ride until expiration. Have you ever gone to a casino and got to put $1,000 down on your favorite number in roulette? That was the house's money. this is the way that you can do it in stocks or options. So if you want to know more, give me a call. That's it for today. I hope everyone got some great information out of here. Everyone, thank you for tuning in. Good luck out there trading. Keep your eyes on EXP.